is essentially exchanging a lump sum of money. So, your defined contribution pension pot will have accumulated a value. You exchange that with a provider and an insurance company such as Canada Life, Legal & General, LV are the sort of biggest players in the annuity market. What they will give you in return for your lump sum is either guaranteed income, guaranteed maturity value, or a combination of the both. So, annuity rates. I guess the most prominent subject at the moment is what has actually happened in the annuity market. So the graph that I have brought up here is essentially showing you what £100,000 lump sum would purchase you in a lifetime annuity. So a secured, guaranteed income for the rest of your life. This is depicting a 65-year-old, and there is no escalation or change for the rest of your life when you start this. So this is essentially going all the way back to 2006, 2007, where we last had the sort of interest rate market that we are in now. And in those years, the rates were slightly higher. But since then, they have been significantly lower. I guess, since I started advising, annuities have never really been an attractive product on purely an income level basis. Looking at it more from an investment perspective, they haven't really compared to other products that we use. You can see since mid 2021 that the rates have really spiked. So they basically peaked about October last year, dropped off a little bit, and we've seen them just consistently rise through the course of this year again. But that just shows the history of where we're at, and I guess the lifetime of AWM is in a period where we've been seeing declining annuity rates. So it's definitely a new consideration for lots of our clients and prospective clients. Would definitely be something we would definitely bring to the table if you are coming for retirement income or looking for sort of pension advice. So with an annuity, you start off, with lots of options. The annuity market, again, has evolved over these years. So historically and traditionally, an annuity was an exchange of a lump sum for a set level of income that was, guaranteed at the outset. The evolution has kind of come along pension freedoms, that we now have an annuity that, sits within the flexible access drawdown world. So that there is lots and lots of options to consider. I'll cover as many as I can today, but this won't be exhaustive, and it's not, everyone's situation is different. So that you will get a personalized recommendation when you look at annuities. So I guess the first thing to think about is, with an annuity, you can either target a level of income. So you could say, I would like £12,000 a year. How much lump sum would I have to trade in order to achieve that? You also could look at it as, a percentage of your overall planning. So, some people with pensions would say, I actually like the flexibility of defined contribution, flexi access drawdown. So, I would like to keep 50% of my pension in a totally flexible environment. The other 50%, I would like to consider some guarantees or some fixed income for that. So, on those two bases, you end up with being income driven or contribution driven. The next one is single, joint, or dependents. So you can set these policies up just for yourself. You can set them up as a couple, so your spouse or partner could be initially written into the policy, and you have multiple options on what happens after your death and how that passes on. And then likewise with dependents, if you have a dependent, you might want to consider how they will survive after your death. And there are provisions within annuities that would suit that. The next thing is the term. So the two core annuity products are lifetime products, or what we call fixed term plans. So the lifetime products is simply, as it says on the tin, is for your lifetime. And then the fixed term product, you define the number of years that you would like the product to run. And that is where we start. Income. So on some of these products, you can define the income, you can amend the income, or you could have no income, and I'll show you how that is relevant later on in some of the plans. Obviously, with the lifetime plans, they are a packaged product, and you would take income from them. Death benefits, again, is a very prominent aspect in the pensions world. So, lots of you have considered death benefits and heritability of a pension or your pension savings. Obviously, that converting a pension as in the flexible world to an annuity comes with changes. So whether death benefits are important, that would be a consideration when looking into this. So I will start with lifetime annuities. As it says there, they are simple and secure. So as it says on the tin, you set it up at a fixed contractual agreement at the start. Nothing changes through your lifetime, and they are ultimately guaranteed. Guaranteed is not really a word we can use very much in the financial advice industry, but with annuities, I can. So with an annuity, you don't have any investment risks. So, with a pension that is a lump sum, however that is invested, there would be a form of risk associated to that. With an annuity, you don't have any market exposure, and the word guaranteed comes into it again so they offer you peace of mind. With a lifetime annuity as well, there is a health aspect to it. So a lifetime annuity, as I said right at the beginning, is essentially an insurance product, and a lifetime annuity provider would be able to underwrite the policy on your life expectancy. So if I get into sort of the nitty-gritty of a lifetime policy, so first things first, income levels. So for ease, throughout this presentation, I've used a lump sum of £100,000, just so the rates and the levels are consistent throughout, so they're comparable to one another. In this example, I've used a 60-year-old person, man or woman. They get the same rates. So 60 years old, and these first set, so the orange, they are level, and level means that there is no escalation on the income throughout your lifetime. So obviously that means you would get more at the beginning, but the income level doesn't necessarily keep up with inflation. So these are the rates, kind of the headline rates, the rates you would see on newspaper articles, and on financial commentary. Usually a 60-year-old, 100,000 and level is that rate. So right now, you would get £6,470 over the course of a year if you wanted it paid monthly. If you opted for it to be paid quarterly, you would get £6,505. and then annually you would get 6,667. So you can see, even with a slight change right at the outset, so just the frequency of the payments and how often you were to receive the income, there is a difference. So, you are rewarded for leaving your lump sum untouched for longer. So that, is something to consider. In most cases, I would expect that monthly income would be the optimal, and it is what most people sort of do target. They want that sort of replacement for earned income, especially if they are transitioning into retirement. If you are looking for a bit more of a guarantee or peace of mind, or you want to just de-risk your retirement a little bit more, the annual income might be more suitable. So that's option one. Option two there is adding in an escalation. So adding in an escalation means that from the outset, so from the first payment, there will be a 2.5% increase per annum. So that is fixed. It's not tied to inflation. It's not tied to interest rates. It just is a fixed 2.5% throughout your lifetime. That obviously costs. So what happens when you do all of these additions and change the terms of the policy? Some things are more costly than others. But obviously, you do need to consider, do I actually appreciate that 2.5% increase? Because you would get more and more in the same term. So again, another important one to consider. And those, I guess, are a step one in a lifetime annuity. Step two is whether you would consider a joint annuity or having a dependent on your policy. So a joint annuity is where the annuity is written with two individuals on the plan. So that is set from the outset, and yeah, it basically would have a sort of, in the world of spousal benefits, it would be what it's called. But some providers are different on who can be dependent, who they will allow to be added to the plan. But yeah, in general, spouse partner would be written onto the plan with you, and we would define their benefit or their post-death benefit at the outset. So what I have done here is done a 50% and 100% spousal benefit. So comparing it to the single, you can see, how much it costs or at the outset per annum to have that spouse on the joint policy. I have compared both here with the level and the 2.5 escalation. So, with the escalation and 100% benefit, you can see, that there's nearly £1,000 per annum on there. But yeah, the importance of these factors are very, very different for every single individual. So when we look at these, that's kind of the aspect we go in, and we can actually assess the cost of it. So we also then have death benefits. So as I mentioned, inheritability of a pension is very important. Some people really want to preserve their pension for future beneficiaries. So having an annuity, although it might be very, very attractive from an investment perspective or guarantee in your lifetime, you may also, consider the risk of accidental death, early death, getting ill, anything like that. None of us can say how long we're going to live. So on these lifetime annuities, there is a consideration on death benefits. So you can have all of these wrapped all together, and I'll try and summarize them after. But what I have done here is just compared the level terms. So there is no escalation in these rates. will start with the single policy. So, we go back to the single, no guarantees, no escalation on there, and that was 6,470 per annum. If we have a guarantee, so we look at a 15-year guarantee, and what that means is that there is 15 years, whether you are alive or dead, that this policy will pay and this policy will exist. You obviously nominate beneficiaries at that point because you've set it up on a single life basis. So, that single life basis there is important because you can maximize the initial income, but if there is a set period where your spouse, your beneficiary, a dependent would require this income, that can be provisioned for, and you can see that the guarantees at the moment aren't too expensive. It's not costing you an excessive amount per annum. Well, you're not giving up an excessive amount per annum to have that in place. The other benefit is what we call what is called value protection. So value protection is as simple as your initial contribution, so your lump sum that you have transferred over to the annuity, minus all the income paid, and then the value of that is paid out as a lump sum death benefit. So you can, if these were larger sums, it would become a bit more important there. But yes, sometimes that just is a bit of peace of mind that, I'm not actually going to lose anything if I only live 3 years. I will have had that income, but my beneficiaries would have the excess. You can also have these death benefits on a joint plan. So I've chosen to use here the joint plan with the spousal benefit at 50%. So again, you can see that the 15-year guarantee is exactly the same. So what that means is that the whole policy is guaranteed for 15 years. Gets a bit tricky here because you can have overlap. So the quote that I've put there has an overlap on. The overlap means that the guarantee period will guarantee the annuitant's income. So that £6,029 per annum paid monthly is guaranteed for 15 years. If the annuitant passes away in 10 years, the spousal benefit at 50% would start at their death at 50% of 6,029. You can undo that, so you don't have to have the overlap in place. So the 15-year guarantee stands, the spousal benefit would start after that 15 years. But again, something to consider. The providers also have different terms. Some of them have to have the overlap, some of them give you the option. So yeah, each policy is slightly different with joint and death benefits. But the value protection is, exactly as it says on the tin, money in minus money out equals the lump sum death benefit. So you can see pretty much costs nothing per annum to have that in place. Obviously, the risk and the underwriting from the insurer's perspective, if there is 2 people on the plan, £6,114 paid monthly per annum to the main annuitant. The spouse or the second person would then receive 50% of that. So it actually wouldn't take many years for the first 100,000 to be run down to nothing. So it's around the 15-year mark, and that's why that 100% value protection on a joint policy doesn't cost very much. So I have just rambled on with a lot of information there. So what I've done here is kind of summarized it together all in a matrix. So across the top line, we have the single policy, which is always the baseline, and always the baseline that you kind of start from and consider. So that single, and then an escalating single, so escalation by 2.5%. We have then the joint policies with the spousal benefit, joint policies with spousal benefit escalating at 2.5%. So, where you fit in there, you then go down the 3 options on the death benefit side. So to have no protection at all. So, you benefit from this only in your lifetime and you're comfortable with that, you would obviously get the highest rate there. If you want a guarantee, that's the 15-year guarantee there. Costs on income, but could be very, very important if there's a specific time span that that this money would settle a debt or pay interest, or you've got a fixed term arrangement. You can fix your plans to suit that. The value protection, again, in these scenarios doesn't cost very much at all. But yeah, it is there, and if there is a consideration on life expectancy that you might have, the value protection, is there as an absolute sort of backstop. The final section on on lifetime annuities is enhancement. So I think it's something that gets overlooked quite frequently in the lifetime annuity space. Enhanced annuities are, you have to be 100% healthy. You have to have lived a very, very healthy lifestyle to sort of get to that stage in life where you're looking for an annuity, and there is history of smoking. So smoking when you in your very early stages of life, could well have a factor or an enhancement that is applied to your lifetime annuity. Alcohol consumption, even your weight, if you are underweight or overweight, that does sort of go into the algorithm that I guess changes your life expectancy on paper. So all of those things would actually uplift these base rates. So I have shown you not unenhanced annuities throughout that presentation. But yes, certainly if there is any history of illnesses, high blood pressures, asthma, chronic conditions, you may be healthy now, but have a history of cancer, or anything like that. I just think point here is declaration of all of these things, because we have actually seen an enhanced annuity rate that was increased by 30%. So, even if we could get a 2.5% uplift, it is definitely worth doing. And there is, there's a health declaration that you would fill out when applying for a lifetime annuity. And, if there is anything in there at all, it's best to disclose them, just because there is one medical underwriting or one medical assessment done in an annuity application. If you don't declare it there, then you can't really change it down the line. So that kind of wraps up the lifetime terms. So the lifetime terms in a summary, you pick a day, you exchange a lump sum for a fixed amount of income with a fixed set of conditions that you choose. So that's how lifetime annuities work. Fixed term annuities are where this product has evolved to. So lifetime annuities are the more traditional. They've been around pretty much forever. So fixed term annuities have come in, pension freedoms, made them more widely available. And they are actually a way of flexibly accessing your pension. Again, they come with no investment risk. So these still remain as insurance products. So there is no investment risk to them. you know, if there is a set period of time that you would like to set, you know, ease your concern on markets, or if you're particularly risk averse, you know, these might be suitable products for maintaining your flexibility in the long run, but, you know, giving you that underlying guarantee. So the period we usually see is about 3 to 20 years. Some providers sit either side of that, and it's obviously, you know, dependent on your age at application, whether they will allow it or not. There is no medical assessment done on a fixed term annuity, so there's no declarations of health, and there's no consideration, you know, on these plans of life expectancy. So, you know, if you are unfortunately someone who's, you know, experiencing a chronic condition or you know, suffering with cancer, you know, you really would consider the feasibility of a fixed term. It has additional benefits, but, you know, would you be someone better off with a lifetime annuity with an enhancement? So lifetime annuities, as you saw, I said they were, you know, simple and secure. The two words I would use to discuss the fixed term, or to describe the fixed term annuity, is convenient and customizable. And why I say this is because there are lots and lots of options on fixed term annuities. So, you know, the structure is convert a lump sum for a fixed amount of income for a fixed amount of years and a guaranteed maturity value. So those are the options. Underneath each one, they are very customizable. So these products, we can more assess your needs and build these products to meet your needs. With lifetime annuities, you are very much dictated by market conditions and the rates that are available. So the basic options, you know, as I said, I would use £100,000 in a 6-year-old throughout this. So what I have done here is £100,000 for, and you want 0 income per annum for the lifetime of the product, which we define, or £6,000 per annum. So you can see sort of underlying here, the 3 years would give you a maturity value of 177,167 if you took 0 income. So, you know, over the sorry, that can't say the 5 years, sorry, we'll do 132,706 versus taking the £6,000 income per annum would leave you with 97,950. I will change that number there because that can't be right. So those are the numbers that we have. So taking an income is an option. So you could take nothing. You could take £10 a month. You could take £6,000 a year. You could take £12,000 a year. Your maturity value would just dictate that rate. Well, the maturity value would reflect the drawdowns that you've had throughout the term. So here, we basically look at these products as an investment. So what I've done here is an internal rate of return calculator, and that is showing you the sort of annualized rate of return that these products actually, you know, contain. So on the £0 income over 5 years, the maturity value is 132,706. So, you know, on a simple basis, you have made £32,706 over the 5 years without taking any risk whatsoever. You know, it's a lovely space to be in the advisory world, and, you know, be able to say that I can absolutely guarantee that you know, that I can get you 5.82% annualized over a 5-year term. If, however, you know, you are targeting income, for example, you know, in a 60-year-old currently bridging the gap to state pension age. You know, we might be looking at that sort of five-year term right now. And, you know, the £6,000 of income would be really useful to you throughout the 5 years. On this scenario, we would have a maturity value of 97,950. But remember, you've had the £6,000 annually for 5 years. So the rate of return on there is 5.63%, which, you know, is above a deposit rate. And my personal view is that these won't stick around for forever. You know, I can't predict the interest environment, but you know, our expectation is that, you know, these will be around for, you know, a short period of time, and yeah, not forever, but definitely something to consider, given that this is a completely risk-free rate of return. I have also run the 10-year graphs here. So the 10-year ones show you on an investment basis. Every single year for 10 years, you would be obtaining the internal rate of return that is listed there. So yeah, you know, I think really attractive rates at the moment. Obviously, personal situation comes into it. But yeah, just as a headline example, that is where we can look at. So decisions on fixed term annuities, much like lifetime annuities, there are guarantees. There is sort of additional factors you can have written into the policy. You can have them joint, but you know, all of these are accessible individually, I would say. Again, you know, on a fixed term annuity, are you using your pension pot to provide family income or household income? You know, is there a dependent in that household that would require that income if you were not there? Or would they benefit more from a lump sum death benefit? Things like that really, really do need to be considered. You can write them into the policy. You can exclude them from the policies. Again, guarantee period. So as with lifetime annuities, you know, fixed term annuities are still an insurance product that are underwritten on your life. So they will only exist while the annuitant, so, you know, you with your pension, you are the annuitant, they can only exist throughout your lifetime. So much like lifetime, the fixed term, you know, if we were to look over a longer time horizon, so, you know, 20 years, you know, can we guarantee you are going to live for that 20 years? And what happens if you don't within that period? So, you know, there are guarantee periods where you would nominate a beneficiary. There are other things you can consider on a joint policy. So, you know, if you under your spouse or partner, you know, the annuity would transfer into their name. And how much percent of it do they need? You know, would they want all of it? Should they have all of it? Or is there a percentage that, you know, would be suitable? Also, I've noted on here, can I use this investment within my SIP? So a question that I have been asked a lot over the course of this year. And yes, the answer is yes, you can. So if you have a SIP, and specifically a SIP that, you know, has less restrictive investment rules, so SIPs obviously can be very restrictive to a certain asset class, or they can be very, very expansive and hold a whole range of underlying investments. So long as you have a SIP provider that will accept a fixed term annuity held under the plan as a trustee, it absolutely can be done. What that would look like is, you know, the SIP would be the policy owner. You are still the annuitant, so, you know, it's still assessed on your life. However, you know, any income that is paid back to the SIP. Why is that important? Because I will come on to taxes and things later on. Death benefits, as I said, very, very important factor to consider. And the two main death benefits that exist on lifetime still exist on the fixed term. So you have the value protection. Here, I would value, well, I really value the value protection. I think it's a very, very important aspect to have within a fixed term annuity. Just because, you can guarantee that you are never going to lose money. So, the value protection is a guarantee that you are never, ever going to be worse off. You might not you might not see the guaranteed maturity value if you were, if you passed away within the term of the product. However, you're never going to, or your beneficiaries are never going to be worse off than where they started. So again, money in minus money out equals the lump sum death benefit. I've actually included that within all of the quotes that I've got, or I've illustrated throughout this. So those rates that I have depicted there all include the value protection. Some providers have it as part of their policy provisions, and some providers, there is a sacrifice on either, it'll be a sacrifice on the maturity value that is offered. So if you remember, you choose the amount of income you want from it. The annuity rate dictates the maturity value. A guarantee period or a guaranteed percent versus having a joint fixed term with a dependent's income, again, is a way of structuring a death benefit. So, would you prefer or would your beneficiary or dependent be better off having a lump sum payment or maintaining the same level of income that you had as a household throughout your life? Those things are very particular. They're very objective, and we can structure these products to meet your objectives and meet your goals. The reason I say these are guaranteed products, and something I enjoy saying every now and again, is because they are underlying insurance policies, they have 100% FSCS protection. So, if you're the issuer or the insurer in this case, so the annuity provider became illiquid, wasn't able to meet their obligations would be your annuity, you have FSCS protection, and there is not an upper limit. So with these policies, I guess I can say they're guaranteed. So, when you take out one of these policies, it is absolute peace of mind. You don't take a credit risk, you don't take market risk, you're not taking risk in any perspective. The risk that does exist, is your life. The products are only there so long as the insured persons, the annuitant, and or spouse partner are alive. But yeah, as I hope I've shown you throughout this plan or with the presentation, there are lots of options to protect against that. The timing of an annuity. So when is the right time? Lots and lots of people are thinking about annuities at the moment because of the interest rate environment. I don't think there's an absolute right or wrong time to take an annuity. I think, there will be a point where you have certain objectives. Can we meet them with an annuity? Does an annuity fit into your overall planning? Does it provide that underlying guarantee that allows, the rest of your savings or investments to do other things? Does it give you peace of mind? Does it help you sleep better at night? Things like that. They're all to be discussed. The interest rate environment makes it an easier discussion. You're not giving up the flexibilities into a guarantee. or you're not taking a low rate of guarantee. So it's, it is comparable right at this point in time. Market performance, one thing that I discuss with clients is the opportunity cost of an annuity. I absolutely don't think annuities are right for every single person. I don't think they fit into everyone's plan, but an assessment on the way that it could fit in is one thing, the opportunity cost. So the opportunity cost taking an annuity is, you are fixing in the rates that I showed you, let's say 5.8% for the next 5 years. So 5.8% for the next 5 years, that is a very comfortable rate of return. It might not meet people's objectives. Therefore, their opportunity cost is that, where they're converting the investments from and turning it into is better off where it was before. It could be better off. Markets, as we know, can go up and down. So, yes, that the market performance section there is a comparison between a fixed rate and, other rates of performance that we could have. The last one there is a very prominent question. An annuity purchase in both, so lifetime and fixed term, is a crystallization event. Therefore, if you haven't crystallized your pension, it would release tax-free cash. So, at a level of guaranteeing the underlying income or rate, you would be using 100%, let's say 400,000 of your pension, 25% of it would be paid to you. So 100,000 in that scenario as tax-free cash. 75%, the remaining 300,000 would purchase the annuity. So that aspect of things, is a wider plan, and it's very, very individual. Again, what do I do with the tax-free cash that I've released once once I've decided on that? And what impact does that crystallization have on the rest of my life? The reason I come onto that crystallization is because the money purchase annual allowance is around, it does exist. The money purchase annual allowance is, when you flexibly access your pension, you trigger the money purchase annual allowance, which currently, historically we've been at all levels on the MPAA, but currently it's capped at £10,000. So, if you are actively contributing to a pension, taking a fixed term annuity contract triggers the money purchase annual allowance. Taking a lifetime annuity product does not. So the difference there is that the lifetime annuity is not a flexible, it's not classed as flexible access drawdown. As I stated at the beginning, it is fixed for your life. So, there is no amendments to it. You can't stop it. There's no cash in value on a lifetime. So if you crystallized and purchased a lifetime annuity plan, you would not have triggered the MPAA. However, if you purchase a fixed term annuity, because a fixed term annuity is a flexible access drawdown contract, it does trigger the money purchase annual allowance. These are just some examples for consideration. I realize I've overrun there, so I will whiz over them. But, if you are still in employment, does the drop in the LTA make it more attractive to continue contributing to a pension for, the initial tax relief? If so, you would want to avoid triggering the money purchase annual allowance, for example. Again, do you have dependents? Do you have dependents requiring your income? Do you have a spouse that, you support with your pension income? Again, how do they benefit from that? What structure do you want to consider there? One that I think is particularly prominent at the moment is risk appetite. Markets are markets, and they've been up and down and choppy. If you are someone that is particularly cautious, has been particularly cautious, are feeling, particularly cautious right now, adding an annuity into your asset allocation, so into your underlying and overall allocation of your wealth and your retirement savings, might actually, give you the comfort to do other things to, feel comfortable with where your wealth is if you have that underpinning guarantee. And again, as I said, enhanced annuities are out there. They are great. They should really be considered, and I think they should really be something that more people are looking at. But yes, if you consider yourself 100% healthy, it's not relevant. But if there is something, anything in your history, anything in your lifestyle, that would be worth sort of disclosing and just exploring. Then a personalized lifetime annuity quote can be done, and I would really recommend considering it and exploring your options. But yeah, I think that has rounded everything up for me.
Lovely, thank you, Claire. So we have had a couple of questions come in during the course of the presentation. So let's have a look at some of those. First one we've got here is from Cam. So hi Claire, with more talk of interest rate increases, do you expect annuity rates to increase? Also, can an annuity be purchased and deferred?
Very topical question, I would say, Cam. If interest rates are leading the annuity rate market. So yes, if there is another, 1% base rate increase, I would expect annuity rates to rise alongside that and to reflect that. I'm not saying there will be, I'm not saying that's our expectation, but I would, yes, you are absolutely correct. If there's more interest rate rises, annuity rates will rise. Interestingly, though, the peak of the annuity rates was for this period was in October last year. So October 2022 was the peak, and we weren't at this interest rate environment. So yes, if that helps, it's an answer to that. Can they be deferred? There is a deferred annuity product, but it is very, very different. It's underpinned with unitized investments. So it's relevant to this discussion or this presentation because it's not guaranteed. It exposes you to market risk, and they are quite different sort of wrappers. So the ones I've discussed cannot be deferred. The process of them is you get a quotation guaranteed for 14 or 30 days. And you only meet that guarantee if you fund that annuity. So if the provider receives the funds within 30 days of accepting the application. So yeah.
Okay. And then the next one we have is from Neil. So fixed term, do you need to choose income at the start, or can you choose to have income or not year by year?
You pick that at the start. So you pick the income. One I didn't cover is the frequency of the income. So again, you can choose monthly, quarterly, half yearly, yearly, but they are contractual agreements that you enter into at the start.
And another one from Neil. Would you be protected if LTA comes back?
So, because these are benefit crystallization events, you would have taken your pension from an uncrystallized, unvested pot and you move it into the crystallized section. Therefore, two areas of that, if you've done it, you know, before lifetime allowance and you know it's on a segment of your pension that's over the lifetime allowance, if you do it while there is no charge, i.e. now, you wouldn't be exposed to it. As you all know, there's a, you know, well, there is a second test of the lifetime allowance at age 75, and an annuity historically has been counted in that. Two different calculations done for lifetime and fixed term. But yes, before, well, in 22-23 tax year, if you turn 75, your annuity value would have been counted at the age 75 calculation.
Okay, and from Paul, is it possible to invest a percentage of my SIP as a lifetime annuity and defer it for 5 or 10 years?
No. So same question. You can take a fixed term annuity for that period. And, you know, as I showed, take zero income from it if income's not your goal at the moment. But, you know, there's other considerations that would be considered, well, you would have to take into account, such as the benefit crystallization event, potential release of tax-free cash. But no, I wouldn't. I won't say I won't recommend, but I haven't recommended any deferred annuity contracts because they are exposed to market.
And then from Richard, are there any benefits of a fixed term annuity over a fixed term cash ISA considering tax implications?
They are very, very different things. So an ISA obviously it would remain in an ISA wrapper. A fixed term annuity is a pension. It comes with all the pension benefits, and you know, currently the exemption from inheritance tax. So a fixed term annuity, you know, is the same as ISA or pension contributions. You know, do they meet your needs? But there are benefits. So the answer to your question is yes, there are benefits. There are also, you know, drawbacks. There's also restrictions. So which one of those, you know, is weighted the heaviest for you, I guess it is a very, very personal question. But the maturity value on a fixed term annuity remains as a pension. So it retains the kind of pension wrapper. So yes.
Okay, and it doesn't look like we've had any more questions come through, so that should conclude our Q&A session. We will be leaving the survey up, so for anyone who has got a couple of moments, please do just have a little look at that for us. Claire, thank you very much for your time, really appreciate that. And as usual, we will be sending out the recording and slides as well, so you guys should receive that later on today. Otherwise, we will see you at the next webinar, which is in September the 28th, and we will have Noor Bisa here to discuss mortgages. So we hope to see you there.
Thanks, everyone.